name is Rawley Thomas. I'm Vice President of Practitioner Services for the Financial Management Association here. And we're honored to have quite a panel to talk about one of the most challenging aspects of economics and finance facing the world today. So that's who I am. I'm also President of LifeCycle Returns. And without further ado, to my right is Blecher, Senior Vice President at LPS Applied Analytics. And then to my left, immediate left, is Austin Kelly, the Associate Director, Housing Finance Research, Office of Policy Analysis and Research, the Federal Housing Finance Agency.
You got it.
And then to his left is Ron Meer, who's Chairman and CEO of Ironwood Holdings. With no further ado, we will start. The general idea here is we'll have 15 to 20 minutes worth of a presentation. If you would hold your questions, we are planning on leaving some time at the end for questions from the audience, and we may have a couple of questions from the moderator here too. So without further ado, let's just start with you, Herb, and you're on.
All right, thanks. And it's great to be here and among an esteemed panel. What I'm going to try to do here today to set us off a little bit is to give a little bit of background of where we are in the crisis, what's happened to date, and then talk about, generally speaking, what we're seeing, what the state of information is, give some background as to what's actually been going on as far as foreclosure mitigation or loss mitigation. I think the terms at one point were interchangeable. I don't know if what we're seeing now necessarily qualifies those. So I will dive in with just a start, where we are as far as delinquencies and foreclosures. Things are improving, but the questions we're talking about today are still very relevant. So the question of how to handle the extremely bloated inventories of seriously delinquencies and foreclosures. We're about 5 years into this crisis at this point, but still these questions are very relevant. As we're looking at this, what I've done is combine 90 plus in foreclosure inventories. So this is seriously delinquent in foreclosure. And you can see, really, it started back in 2006, mid-2006. Once home prices started, or really stopped climbing, that was enough to start delinquencies increasing. Once they started declining in earnest in 2007, we really saw a significant ramp up. And you can see we peaked over 5 million loans in 90-day delinquent or foreclosure status. That was in January of 2010, so pretty recently still. We've come down quite a bit. Part of what we're seeing there, the modification programs that have taken place to date, in particular HAMP, have in some ways contributed to that bottleneck there. And what we've seen recently, especially over the course of 2010, is a lot of the clearing out of that backlogged inventory. Once HAMP was announced in early 2009, many servicers pulled loans out of foreclosure, started evaluating, started to get their processes set up, but that took some time. And so as that occurred, the 90-day delinquent inventory bubbled up a little bit. So arguably maybe that peak up there was somewhat of an artificial peak, but we have started to see things clear out. We're just over 4 million loans that are in that 90 plus delinquent or foreclosure status today. To take it out a little further, we do some projections, and we've got a couple different scenarios here. Just to be clear, these aren't forecasts. So you tell us where you think home prices and interest rates are going. We'll tell you where we think delinquencies and foreclosures are going based on that. Our optimistic scenario assumes that we're going to revert to mean levels of appreciation basically starting today. Any optimists in the room? No.
I'm closing on a property next month.
Okay. The pessimistic is more like reverting to the mean starting in 2013. So, personally speaking, we're starting to change our optimistic, pessimistic scenarios just because we don't see a lot of hands, except for the home buyers in the room. Depending maybe on hopes. And so the other thing that I've got on here, so you can see based on that projection that if home prices decline and we're teetering right on that edge right now, we could ramp back up. And so not only are the questions we're talking about still relevant for the current inventory, but for what may be coming down the pike. That dashed line down there just shows you where those normal levels are. Normal is a relative term, so we say between 1995 and 2005, where the rates were, what those counts would be. So we're not getting back to those levels 2016 in the absolute best case. Okay, so taking a closer look, where we've seen a lot of the activity, or at least you can perceive it when we look at the graphs, is in this seriously delinquent category. So within this category, we've had about a peak of 3 million loans. It's cleared out by about 1 million loans over the last year and a half or so. And that's due in large part to the 2 million modifications that have taken place starting in January 2010. HAMP, as well as the proprietary modification programs that accompanied it. So we have seen that seriously delinquent inventory start to clear out. However, we still have a lot of bottlenecks in the system. And the major one right now, used to be that the bottleneck was, as I mentioned, on the loss mitigation side. So servicers were looking at evaluating loans, doing everything they could to implement the modification programs as they were coming. The peak of that was in 2010. It introduced a bottleneck around the time of foreclosure start. In fact, a lot of loans that had foreclosure starts were pulled out of foreclosure, put back in that seriously delinquent status, and then addressed for modifications. That bottleneck has moved, so we've seen a lot of modification activity over the last year and a half, 2 years. But the new bottleneck is at the foreclosure completion stage of the game. And as we'll see coming up, it's pretty stark differences. So the geography starts to matter a lot. At the point of foreclosure start, it was really investor driven. Agencies, as HAMP rolled out, and Fannie and Freddie made an announcement, maybe mid-2010, correct me if I'm wrong on this, Austin, but saying, look, evaluate these loans for HAMP. If they don't qualify, move through with foreclosure. Let's keep things going. And we did actually see an increase in foreclosure starts around the middle of 2010. So that stage of the game is really investor driven. What we're seeing now is really a state-by-state difference, where the difference is whether you process your foreclosures judicially versus non-judicially. And just really simply, you can think of judicial foreclosures. I hope I'm not explaining what everyone already knows, but judicial, you can think of, you actually have to go to a judge, so a person has to be involved. Whereas in a non-judicial state, there's a process that allows you, or allows a servicer to move forward with foreclosure without having to get a judge involved or get real people involved. And so that's really made a difference in what we're calling the pipeline ratio. And what this is just the 90 plus in foreclosure inventory, the seriously delinquent inventory, over the number of foreclosure sales that we're seeing. We can think of it as how many months would it take to clear the current inventory. Again, it's not a projection. What we're seeing now is anomalous behavior, so it's not, we hope, going to take 50 years to clear the pipeline in New York. But right now, effectively, there are no foreclosures taking place because attorneys generals, legislatures, judicial branches have gotten involved and said, we're going to halt foreclosures. So I think that the question here is, as we're seeing modifications going down, what's going to happen? That's where I think about foreclosure mitigation versus loss mitigation. You can make a good case for modifications, keeping the borrower in their home. In most cases, that's going to actually be better for the investor. But if we're halting foreclosures for the sake of halting foreclosures, then you're just building losses. You're building further deteriorating properties, et cetera. So at the aggregate level, you can see, it may be hard to see there. So the non-judicial states in the aggregate have got about 31 months of inventory. It's not too bad, 3 years of inventory, a little less. On the judicial side, 104 months. So we're looking at 8 odd years there. And some states are really off the charts as far as that goes. So I think it's relevant, the things we're talking about still in non-judicial states. It's really relevant to judicial states as well. And here's what's been happening as far as modification volume. So I alluded to this. So we had a peak in 2010. A heck of a lot of modification activity took place. Still a significant amount of modifications taking place. This data is from the OCC's mortgage metrics report. So just to be clear, when we're looking at these counts, they represent about 63% of the industry. And so I didn't extrapolate these numbers. But we're still seeing significant levels of modifications. But cleared the low-hanging fruit, cleared the mid-hanging fruit, and each new modification is that much more difficult to get done. So what's the impact that we've seen from this difference in judicial versus non-judicial states? Well, just looking very quickly at home prices, focusing in on the last year, because really this is when the full change came into effect. So back in September or October of last year, you had already called robo-signing, foreclosure gate, pick your tagline, but that was the point at which most of these judicial states really put a halt on foreclosures. The judicial states always took a little longer to process things, but if you look at the line as far as that pipeline ratio, it spikes up in October of 2010. And so that's had an impact on home prices. So home prices with less inventory, supply and demand, home prices have actually performed better in judicial states. Now the question is, are we just kicking the can down the road? That pent-up supply has got to make it out there at some point. So this certainly could be short-lived, but at least from an impact perspective, as far as what we've seen so far, judicial states have outperformed based on that moratoria. So what are some of the other impediments to implementation that we've seen over the past couple of years? Well, yeah, I think there's enough finger pointing around, especially when you talk about the politicians and whatnot. But I think from an industry perspective, what we've seen, and we work very closely with mortgage servicers, we also work closely with the government, is that everybody's been working very hard to try to make something happen. But this has never happened before, and so it's taken time to figure it out. We saw that pop in the 90-plus delinquency. As a result of that, you've got to have systems in place to affect this stuff. You've got to have people in place to do it. So you'd see a lot of people moving from originations and moving over to default, and then having to learn about loss mitigation, and then moving back to default. You need people, and you need systems to deal with it. I think those have evolved certainly over the last year and a half significantly. We've seen vast improvements in both the systems as well as the data. There's still a lot more to be done, but it's starting to have its effect. And then once the storm settles, or as it's settling now, really further developing those. So, talking to people like you, doing the analysis in the government, figuring out what works, what data do we have to tell us what works, what data do we need to tell us what works. That's where I think the conversation today is extremely relevant. So what are the things that you want to do? What are some potential solutions? Well, number one, product and risk segmentation is absolutely key. So this is a very simplistic example. I saw an article, the Bureau of Economic Analysis released a paper over the last couple days, and I think the title of the article was somewhat, the title of the article, I'll let you decide, was "Different Mortgages Default in Different Ways," or something similar. I'm not sure if you saw it, but it's true. The differences matter. It's obvious, but getting to the level of differences is really what's key, and that availability of information is a challenge. So we can break things down by product. That's somewhat readily available, and we see that prime and agency prime and non-agency jumbo prime obviously perform differently from subprime. We twisted it up here, but depending on how you look at it, some things might shock you. So subprime delinquency rates, everyone would guess, are a good multiple of what agency prime rates are. But if we look at what the deterioration was, what are the expectations versus the actuals? You can see it almost flips the stack. So what's been the greatest amount of deterioration that we've seen since January 2008? Well, it actually works down what you think of as the quality stack. Non-agency jumbo prime had the most deterioration since January of 2008, followed by agency prime. Subprime's at the bottom of the stack. So for starters, very simplistically and probably obviously, you want to jump in and do product and risk segmentation. What do you want to do beyond that, though? I think, I won't let my personal bias here. I work for a company that sells loan level data, full disclosure, but the availability of loan level data, be it from a vendor, be it from the government, be it from publicly available sources, as non-agency data is, it's absolutely critical at this point. The CFPB was organized and tasked with doing analysis. The OFR was organized and tasked with doing analysis, and they're all going after loan level data sources from everywhere, from OCC, from the non-agency sources that are available from us. The FHFA is making a push towards increasing the availability of loan level data. And this is what we need. We need that information because aggregate data just doesn't cut it. If I have this, great, I can tell that products are different, but I need to be able to segment by credit score. I need to be able to segment by loan to value. I need to be able to see that current loan to value. I need to see documentation detail. If we're talking about modifications, I need to see what the attributes are. So segmentation really allows you to get the optimal resources for risk allocation. The same thing works for modification performance. Where is my risk? So this graph shows us that 57% of estimated losses are going to occur in the 11% of the riskiest loans. It's not quite the 80-20 rule, but 83% of the losses take place in that first 31% of the riskiest loans. You can do the same thing for modification performance. So when we look at modification performance, what actually performs better? What has the most likely chances of actually succeeding? What are those attributes? And being able to dig down to that level of granularity, I think really gives you the ability to answer those questions. What it takes, and going back to the only slide that I had with words on it, what it takes is time and resources, because you need technology. We're talking a lot of loans and a lot of information. You need to build out the systems, you need to build out the people, you need to build out the mechanisms for making sure that everything's accurate. And I can tell you that from vast personal experience there, it's extremely challenging to make that, and it's constantly, you need to constantly work on that. So I'll just wrap up with a couple. I started with the bad news slide. I'll wrap up with a couple good news slide to show how some of that evolution has already taken place. And I think some of it, HAMP has taken its beatings, I think, for the volume of modifications. Maybe the actual number of modifications didn't line up with the expectations. But I think what we have seen is that it also incented, or it provided a basis for servicers to come up with their own proprietary modification plans. So if we go back to that modification chart, HAMP is still the minority of modifications taking place, but a lot of what's going on in the proprietary space is similar and it has increased along with that HAMP activity. And so what we've seen is that the attributes have changed significantly. As people have looked at the modifications that they're actually executing, they've changed the characteristics such that they work better. And we see that in the next two slides as we're looking here at the percentage of modifications that result in a payment reduction. Clear as day. Back in Q1 2008, only 37.5% of the modifications that took place had a payment reduction associated with it. When we get to Q1 2009, it was 53.3%, and then I think that jump is right around the time that HAMP was announced and HAMP was starting to be implemented. We see payment reductions jump right up and actually continue up. So we're at the point now where we're at the 90% of modifications have a payment reduction associated with it. There's a myriad of combinations of modification of modified attributes that can make things work, but these effects have had a clear influence on the performance of those modifications. So here's a stack of by vintage of modifications. So the quarter that the loan was modified and the redefault rate after modification. So we've got 3, 6, 9, 12 months, and again, this is from the OCC's mortgage metrics report. And again, it's just as steady as that last slide. As those payment reductions increased, modifications performed better. It makes sense, but it's surprisingly hard to implement. And you want to do it in a way that is optimal, right? You don't want to reduce the payment too far. You want to reduce it to the point where it's going to stop the borrower from redefaulting, keep them in their home, but maximize the return to the investor. So I think those are the overall challenges that we're facing right now. Hopefully that gave you a good backdrop, and I will turn it over to back to Rawley.
Can you figure out how? Yeah.
Yep.
And then get set up for the next one.
Okay. Yep.
Well, we'll let him get you set up here.
All right.
Is
Sure.
there anything you'd like to kind of say while we get set up on the next slide here?
Sure. While we're getting set up, just a little bit of background on how I was sort of pulled into this. When the administration was laying out the HAMP program, one of the things that they needed to do was to come up with an NPV model, because the goal was to make sure that investors were made better off and not worse off as a result of the modification to the borrower. So a rather strange interagency team was developed. The model builders at Fannie Mae and Freddie Mac did the real work. Treasury sort of laid out the policy. There were groups at FHFA and FDIC that did the really ugly code testing work, and my job was chief cat herder to make all of these pieces come together. Actually, I should say, David Pearl at FHFA was chief cat herder in the beginning, in fairness. I took it over after a few months, and I've been doing it for the last few years. So I'm here to talk a little bit about loan modifications. And one of the first things that I wanted to note was that the whole idea of loan modifications isn't new. As we were working on a paper to do this, I was doing the lit review. I was able to find the 1989 GAO report about the use of loan modifications at VA. Chuck Capone at HUD had done a really nice paper in 1996 on loan modifications. I should have put up there and didn't. Larry Cordell had also done a nice paper in the 1990s on loan modification programs at Wells Fargo. And then we had 20 years of stability in the housing market. Everyone seemed to forget all of this. And suddenly in 2009, we find Willen and Company rediscovering the notion of net present value and why you need net present value calculations in the world of loan modifications. While all of these previous papers were really interesting in the sense that they laid out, why you need an NPV model and the general concept of why you need an NPV model, the one thing they all kind of lacked was how do you do it? What parameters should you actually put into a default or a redefault equation? So that's what we were tasked with rediscovering anew in 2009. The basic mechanics of an NPV model are strikingly simple. You're going to spend money on a modification. You're going to reduce losses. Do you have to spend more money than you save in losses or less? Hence the net part. Heuristically, you're calculating the cost of the mod. The borrower is going to write off, the lender is going to write off some principal. The lender is going to give some reduced payments and provide a below market interest rate, whatever. There's some costs attached to doing the modification. There's some benefits because you end up with fewer people going to foreclosure, and foreclosure is hideously expensive when it happens. And you net the two out. The basic structure is really just 4 sets of cash flows. You put a value on the cash flow if the loan gets a modification and the modification is successful. You put a present value on the cash flows if the loan gets a modification and it's not successful. You figure out the probability of being successful or unsuccessful. Take the weighted average. That's the value on the first part. Is there a pointer? Yeah, on the first part. Then you have what's the present value of the loan if you don't give it a modification and it cures anyway, which is part of why this thing is so expensive. You have to spend money on everybody, but some of the people you're spending money on are people that you didn't need to. They would have cured no matter what. Get the present value of what happens if you don't give it a modification and it defaults. You take the weighted average based on the probability of default. That's that part. You net the two. That's the net present value. The tricky part, of course, are these probabilities. Everybody has a pretty good idea of how to get a cash flow. Everybody has a pretty good idea of how to discount a cash flow. How do you figure out the probability of a default on a loan that gets a modification? Or for that matter, the probability of default on a loan that doesn't? So the first part is clearly the trickiest part, building a default model. The cash flows actually aren't all that hard or all that contentious. There's a wide amount of variability around things like distressed property value, but basically you now, at least at this point, have a huge amount of data to get averages by state, averages by loan type. There's never a lot of contention around this part. Investors were smart enough to know that the conditional prepayment model is almost as important as the conditional default model, but the press and other people have never quite figured that out. So we've got plenty of heat from investors on the prepayment model and no heat from anyone else on the prepayment model. The key thing of the HAMP program was that incentives were built in. They've got to be incorporated in the cash flows. I'll talk about those in the next slide. As we were building this, the discount rate was hideously contentious among investors, which always confused me because we did sensitivity analysis and found that it was largely a red herring. That you could go up and down 200 basis points and actually have very little difference on the net results. Nonetheless, we spent a great deal of time with investor groups on precisely what the discount rate should be. So the features of the HAMP program: loans have to be originated earlier than 2009. It has to be owner-occupied. Front-end debt-to-income ratios got to be greater than 31%. The reason for that is that the whole point of the HAMP program is to bring the borrower's payment down to 31%. If you're already at 31 or below, then there's no way to bring you down. And it has to be NPV positive. That was the protection built in for investors. We're only going to do modifications if the investor is not made worse off as a result of it. So there's a waterfall, as it's known, to get the borrower down to 31%. You reduce the interest rate with a floor of 2%. You extend the term out to 40 years. And if necessary, you forbear principal. There is an option that investors can choose to do principal forgiveness instead of principal forbearance. Later we'll get to a slide that shows that that's rarely used, but it is used on occasion. And again, there were investor incentives built in as a sweetener to get investors to agree to the deal. The first one is a home price decline payment. I'll talk about that a little bit more in the next slide, but essentially one of the costs of doing a modification is that if the loan does go bad, the loan goes bad 6 months later, 12 months later. If house prices are going down, you've just made severity of the loss that much worse. So in declining markets, the investor gets a little extra payment to work as an offset to that effect. There's a payment reduction cost share. If the borrower is at 41% debt to income and you're going to bring them down to 31% debt to income, half of that is paid for by the investor, half of that is paid for by Treasury. In mods done for GSEs, by the way, there's no Treasury payment. The GSEs eat it. But for privately owned mods, Treasury pays half the cost of the payment reduction. The investor gets a one-time $1,500 payment if the modification is successful. And the borrower gets a principal reduction of $1,000 a year after every 12 months of successful payments. So this is to some extent a sort of backdoor principal reduction. The borrower is made better off because their UPV goes down. The investor, of course, is made better off because the probability of default goes down, and the loss given default, if the loan does go bad, goes down. So this is money that really flows through the borrower, ultimately to the investor. I'll talk a little bit about the house price decline protection. Remember I said this was a joint Fannie-Freddie team that actually did most of the modeling. I'd like to point out that one of my friends at Fannie Mae assembled this graph. It shows how far off Freddie Mac's house price projections were. He used as an excuse, Freddie regularly each quarter produces a standard set of house price projections. Fannie's public projections are a little more scattershot and haphazard. Therefore, he had to use Freddie to show how far off they were. Nonetheless, every quarter, this is what Freddie was projecting. And every quarter until the last year, they were way off, essentially either under calculating the serious momentum during the worst slide or projecting the momentum after things turned around. Only when things go flat do they actually manage to make a pretty good projection of actually going flat. Now, we may laugh at my friends at Freddie for this, but I have yet to see anybody else's out there projections that were any better. And this is simply for a national market. To do a house price protection payment, you had to do it in local markets. If you can't get it right at the national market, it's really difficult to get it right for zip code 60629. So the house price protection payment was actually built purposely to be as sort of naive and simplistic as possible. It's essentially momentum. If prices have been going down for the last 4 quarters, in the MSA, you project that house prices are going to go down the next 4 quarters. The general presumption is that you will do a terrible job loan by loan on that sort of process, but the investor doesn't care about a particular loan. The investor cares about a geographically diverse pool of loans, and you'll get it right for investors on average, even if you go way off on individual loans. And investors seem to accept that. So that's the house price protection component of HAMP. I want to do some comparative statics, and we sort of picked just one kind of random loan with some characteristics. We wanted to vary one of the characteristics. We wanted to see how the NPV model would value that. The reason for this is I want to get at the idea that the NPV model is basically doing triage. And this was a real problem we had when housing advocacy groups were insisting that people who are rejected for HAMP mod get a letter explaining why they were denied. The problem, of course, is that you can be denied because you're too good, and you can be denied because you're too bad. And it was very difficult in practice to come up with wording on those letters that would explain what was going on. But I just want to take a loan with sort of the standard set of characteristics. Oddly enough, one of the most important characteristics is left off there. I don't know why. It's a $200,000 UPB. But you take a standard set of characteristics, and you ask yourself, how does the NPV change when the mark-to-market LTV changes? This can give you a real good idea of the comparative statics sort of test of what's going on in the NPV. So you're starting with a loan that's 120 LTV. And so you're there, and you're asking, if we change the LTV, how does the NPV change? And why does the NPV change? Well, it turns out that if you go from 120 LTV out to about 140 or 150, the NPV gets very slightly better. Once you go up much past 150, the NPV actually starts to get worse. And the reason is that the default probability is going up near 100% and is not getting any worse once you're past 150. But the default probability in case of a modification continues to get worse and worse and worse as you get out. So the modification is becoming less and less effective. If you're 120 LTV, a modification has a good chance of saving you. If you're 150 LTV, modification has less of a chance of saving you. So out here in the really high LTVs, the NPV is actually going down. If you go in the other direction, once you're down about 110, 115 LTV, the NPV starts to get worse. By the time you're down about 85 NPV, 85 mark-to-market LTV, the NPV gets much worse. To some extent, that's confusing because the gap in default probabilities is actually getting bigger. You have a bigger chance of saving this guy at 90 than you do at 120 with a modification. But what's going on here is that at 90, there's not much loss. And at a 60 LTV, the investor isn't losing anything. So once you incorporate the loss on the loan, it turns out the modification doesn't save the investor anything. He's getting back 100 cents on the dollar no matter what. But providing the modification is costly. So down in these ranges, there's a cost and no benefit. So it gets back to the idea that the NPV model is doing triage. Around 120, 130, you've got a fairly high NPV, and you say, I really want to do that loan. At 160, 170, 180 LTV, not so much. And at 60, 70, 80 LTV, not so much either. You can do the same thing with payment to income ratio, and that gets a little more confusing. A key point is that the HAMP program writes you down to 31. So if you 31 payment to income ratio. So if you start at 32, you get a very tiny modification. And if you start at 60, you get a huge modification. What the data showed is that initial payment to income ratio does not have a very big impact on default probability. This was sort of initially confusing, but if you think about it, maybe not so much. People who are choosing high payment to income ratios are presumably people with small families, stable income, people who can afford it. What's really going on is that the change in payment to income ratio from the modification gets you a huge benefit until you're out to around 50 or so initial payment to income ratio, and then it's doing very little. So you can get the same kind of effect going on here. This sample loan starts with a 50 payment to income ratio. As you get lower in the payment to income ratio world, you're not doing very much because there's a cost doing the modification. But if you're writing the guy from a 32 PTI to a 31 PTI, you're not helping his default probability very much. So you don't want to give a modification to these people. And if you come out here, you're getting a fairly constant improvement in default probability as you go to higher and higher PTIs. But providing that modification gets more and more expensive. Writing a guy from 60 PTI down to 31 PTI costs you a lot more than writing him from 40 down to 31. So the cost of the mod gets bigger and bigger. And again, you end up with sort of a sweet spot in the 40s, 50s, 60s, maybe even PTI. You want to do the modification. In the 30s, you don't because it doesn't buy you much. In the 70s, you don't because it costs you too much. So you end up with the same sort of triage going on. Oops. Wanted to present some data from a different source than Herb had presented. There's two sources of data out there to look on the performance of mods for the HAMP program. For the non-HAMP, the OCC OTS is really the only game in town. But for HAMP, OCC OTS, which I guess should now just be OCC, looks at the largest, mostly all the largest servicers and a few of the smaller ones. And it's what, 69%? 63? 63% of the market. Fannie Mae collects data from everyone in the HAMP program in their IR2 system. So for HAMP, you can get 100% coverage as opposed to 63% coverage using IR2 data, which is what we have here. The problem is that the OCC OTS data comes out fairly frequently and with a short time lag. Lenders, servicers only have to report to IR2 quarterly. There's a long scrubbing process. This data comes out months behind the OCC OTS report, but it's for 100% of the HAMP world, not 63. So here you can see some detailed breakdowns of performance, and it works pretty much as you'd expect. This one, again, might seem to be a surprise until you think about the mechanics of the program. The higher the starting DTI, the lower the redefault rate. But of course, people that start with high DTIs are precisely the people that are getting the very large modifications. Change in PTI and starting PTI are the same variable expressed in different ways. So essentially, this is saying the smaller the mod, the bigger the redefault rate. Modification vintages. The first quarter started out bad. I think that was a fairly small volume and people didn't really know what they were doing. But people caught on relatively fast. There hasn't been much change in vintage. It's been getting apparently slightly worse, but not much change. Back-end DTI, again, back-end DTI is correlated with front-end DTI. You get the same sort of impact. Mark-to-market LTV. The higher the mark-to-market LTV, the worse is the performance, but it's fairly flat. It's not very steep. With FICO scores, very strong differentiation. The better the FICO score, the worse the redefault rate. Starting days delinquent, loans that are 60 or more days delinquent perform worse than loans that come in that are current. And again, payment change, which is really the same as front-end DTI, expressed differently. The bigger the payment change, the better the redefault rate. Pretty much as you'd expect. We ran a test. Let's see. Suddenly we don't seem to be moving forward anymore.
I'm not sure.
It seems we're frozen.
Yeah, you want to see?
Ah, there we go. Great. Thanks. We just froze. We just want to do some tests to see if the variables that we had in the default model were actually predicting early defaults. And in fact, we got very healthy T statistics with the expected signs pretty much everywhere. Note a strong note of caution here. These are modifications. They're supposed to run for 5 years. We're very early in program history here. This is a very crude, very rough, very early indicator. But it certainly seems, based on early evidence, that the model is working in the expected directions on redefault rate. Now I want to throw in some comparisons here between HAMP and non-HAMP modifications. And because the OTS OCC mortgage metrics is the only game in town for that comparison, that's what these numbers are based on. And you can see that HAMP modifications generally perform better than other modifications. And of course, for the oldest loans, we have the most information. After 12 months, 19% redefault rate for HAMP, 34% redefault rate for non-HAMP. Getting back to the idea that HAMP loans are just performing better. Here we find some idea of why. The mortgage metrics report does not break out HAMP and non-HAMP. They break out HAMP and all. So you have to do a little bit of algebra to get to the non-HAMP. But if you look at the comparison between HAMP and all, you'll notice again that HAMP gets a lot of, HAMP gets a lot of decreased by 20% or more modifications. All gets less so. So if you do the algebra and say what's happening to the non-HAMP modifications greater than 20% change in payment are somewhere around 40%, whereas HAMP are in the 70s. So large payment reduction modifications are much more common in HAMP than in non-HAMP. And here there's a chart showing exactly what kinds of modifications loans are getting. And I'll just focus on the principal reduction. You'll notice that in HAMP, it's anywhere from 2.5 to 5.5% kind of neighborhood, depending on the vintage you're looking at, are getting principal reductions. This is total. Wait. So then down here, no, that's, I may have messed this up. But this is in total, it's somewhere around 5%, 3 to 5% are getting principal reduction. I meant to have a slide on there for HAMP, and I don't. But in HAMP, it's less than 1% usually getting principal reduction. So that means that principal reduction is getting more widely used outside of HAMP than in HAMP, but it's not getting very widely used in any program. So what do we want to do in HAMP world? The answer is first to focus on the successes. Ron talked earlier about the fact that we sort of created this standardized tool, and even if loans are being modified that aren't strictly HAMP mods, the HAMP program has influenced that. We've gotten several requests from servicers to allow the HAMP NPV model to be used by the servicers for their proprietary mods. So the model is turning out to be very useful even beyond the HAMP program itself. And I think that's fairly clear evidence that we've contributed to standardizing the whole processing of modifications, whether or not it's literally the HAMP program. One of the things we definitely like to do is to keep improving the NPV model. We're now on version 4. I was having a conference call yesterday on whether or not we should create a version 5, since the program only runs for another 14 months and it will take us 4 or 5 months to get the version 5 deployed. Is it worth it? We didn't get an answer at yesterday's call, but we're debating a version 5. We would like to continue doing this work so that the next time, hopefully there is never a national crisis like this ever again, but there will be regional crises that will happen. There's nothing we can do about that. The next time there is some sort of crisis, it would be nice to have something we could pull off the shelf rather than try to build it from scratch with some jury-rigged models and whatever data we could pull together at the time. what we'd really like to see is a lot more analysis in terms of different kinds of modifications. We have a pretty good idea now from the HAMP program of what happens when you reduce the PTI down to 31%. Do we know what happens if you reduce the PTI down to 28 or 34? Well, no, we don't. Do we know if the modification with principal reduction is better or worse than the model with principal forbearance? No, we don't. Risk sharing approaches for equity, will those work better? We don't know. We need a lot more research than has been done right now in the world of different types of mods and how well they may or may not perform.
Okay, while we're switching here, I'll let Ron, do we need some help getting a switch?
Yeah.
Well, he's switching. You can introduce yourself.
Very good. My name's Ron Meer with Ironwood Global. I want to thank everybody for the opportunity to talk today and be on this panel. Unfortunately, I'm not going to have a lot of slides with a whole lot of empirical data on it. These guys, between Herb and Austin here, have covered the subject quite dramatically. And what I'm going to talk about a little bit today is the role of practitioners and academicians in solving the problem with government. My particular background in what we're doing here is as a practitioner. I'm in the trenches. I work closely with Jenny May, FHA, and occasionally with some of the GSEs. I'm not an academician. I'm 30 years as an entrepreneur. Been in the political process for 25 of those 30 years in various roles. I'm not a career or an elected official, but I spent half my life in Washington. In my view, the views, by the way, the views that I offer today are hopefully nonpartisan. Political opinions do not represent the administration, anybody in Congress. They're truly my own. Second is I am a principal advisor and put transactions together similar or somewhat in line with what I might talk about today. But it's clear in talking with Washington, there needs to be new solutions from a political standpoint to solving the mortgage problems. I believe that it's important to have academicians plus practitioners to get the solutions. You got to work together with people like Austin and at the agencies with private capital and the private markets to bring a solution that gets government out of the mortgage market to a great extent. And we need big solutions. In my view, this is a big problem, and we need sustainable solutions. We have to think big. We need, from a political standpoint, in my view, we need to clear this overhang in the next 2 or 3 years. The political will is there to do it now. If the answer sustains a longer term clearing period, I think that you're not going to have the focus in Washington to be able to do it. And it clearly, in my view, again, we have to find something that gets thousands of REOs off the market. And what's being considered now in many corners of Washington is how to do bulk sales. FHA right now resolves defaults and foreclosures one home at a time. They currently sit with an inventory of over 45,000 homes in REO. Chuck Capone's own numbers and request to Congress for their budget and appropriations estimate 160,000 homes coming back to them this fiscal year, FY12. They're doing a good job in moving those homes off their books, and I think FHA is doing a good job overall, but they are just overwhelmed, as HUD is. Bulk sales need to be done, and I think they need to accelerate the resolution by tens of thousands of homes at one time, not hundreds or thousands. We need to intervene in the default process much earlier in the process than taking them through foreclosure. modifications, and I think what Austin's been doing in hemp is a great start. We need to build on that from a political standpoint as well as a financial standpoint to do much larger transactions. What you find is, and also we need to do modifications and bulk sales that don't show a redefault just a few minutes or a few months later. Problem is, you got to satisfy multiple taskmasters, and in this political environment, that's saying a lot. We're in a presidential election cycle. Politics take the lead role in anything that's being done in the mortgage modification markets right now, or mortgage markets, period. I'm going to go through where the two camps are right now. They disagree on how to resolve the foreclosure crisis in Washington. On one side, I'll call Camp 1, which we'll refer to probably as the right. This is the Congress and senators in and outside of sitting Congress who are budget hawks. I mean, you have a lot of former senators and congressmen running around these days in Washington with aspirations one way or another trying to influence housing policy. But the budget hawks really represent the right, and they're in both parties, not just the Republicans. Additionally, free market advocates. There's a lot of advocates in Washington that say let the free markets do what they will. Small government advocates, people on the right that think that federal government ought to have a small role or no role in government or in mortgages and the housing market. Academicians who are of the same camp, and Wall Street, which in this case is the majority, but we do have some on the other side as well. A majority are free market thinkers who think that we should let the chips fall where they may. Camp 2 on the left is the more liberal members of Congress, advocates who are for a larger role of government in the mortgage market. There's a fair amount of policymakers in Washington that want to use the mortgage market and housing policy for social engineering goals. Academicians and Wall Street. There's a minority of Wall Street players that believe that there's more to do on the housing market than the right said. Their current positions, 18 months ago, the far right said foreclose as quickly as possible, liquidate at any cost, let the chips fall where they may, clear the market, let it fall to wherever it's going to go, and clear it out. We'll get through this faster, it'll be better for the market and the economy overall. Again, those budget hawks in Washington espouse that very strongly in the form of stopping appropriations in the House budget committees, the Senate Banking Committee, and the regulations that you're starting to see being fought with Dodd-Franks. On the left, they're thinking pre-mortgage meltdown, and this is more than 18 months ago, but it has morphed a little bit, is that government should subsidize housing, let government be the lender, not of last resort, but of first or second resort. They should be very active in housing, and they should use housing policy as a social engineering tool. And let government, and that's where the social engineering comes in, let government help a wider segment of Americans become homeowners. So as you can see, you have greatly opposing camps. I'm sure this is no surprise to anybody that watches Washington or any of the policy fights, where they are now today. And I can tell you this from firsthand experience talking to members of Congress and the administration and to people we work with in Washington. Even the most ardent budget hawks have changed, I'll call it 180 degrees, who now come around to the idea, find ways to keep people in their homes without massive impact to the federal budget and deficit. Okay? They are gone from the ardent position of they've signed a contract, if they can't make it, then get them out and move on. I don't think you'll find any budget hawks, especially sitting congressmen right now, who will tell you kick people out of their homes. It doesn't matter what district you're in across the United States, they all have constituencies now, and even the least affected districts of the United States. Second is, it's very clear that the right wants to give private capital a larger role in solving the mortgage and foreclosure crisis. I think that's critical with the budget problems and deficit problems we have in Washington right now. Private capital is sitting on the sidelines in massive numbers to be prepared to come in. They just haven't found a way to do that yet. The far left today, Camp 2, the way they believe today, is they realize that answers cannot increase the current budget or deficit problems. With what's gone on now and the climate in Washington, even the most liberal member of Congress will not say that the federal government should bail out the homeowners. It just, there's got to be other ways to do it. They just say we can't afford it. We just can't afford it. There's got to find other ways. Second is that you have to find low-cost ways to keep people in their homes. I think this is now in parallel with the right, where the right wants to figure out how to keep people in their homes, and this is where the rights come closer to the left's position in the political spectrum. I've always had a theory that the political spectrum is not, in fact, linear. It's more of a circle where they meet again at the bottom. This is one of the issues where you find the far right, far left, even the most ardent advocates in those positions coming together on the point of keeping people in their homes. And it's important for government to find a way to break the logjam. Again, the most advocated process for this right now is bulk sales. Again, the left has figured out that they can achieve social engineering goals as part of a private capital solution. We'll talk a little bit about that as to some of the ideas circulating around the Hill in the committees and in the political environment right now on how private capital can be geared to still achieve some of the social engineering goals. Okay, let's frame the goals in ways that minimize resistance from the right and the left. The key is finding common ground in the middle. Apolitical goals. Get non-performing mortgages off balance sheets of banks and issuers of mortgage-backed securities. We find agreement on both sides in that. It's a way of strengthening bank balance sheets, mortgage-backed securities. In particular, the segment that's been hurt by this in the mortgage-backed securities are not the big issuers, not the B of A's and the Wells of the world. It actually is the local mortgage banker who has an FHA full eagle and does securitizations into Ginnie Mae pools. You find small mortgage brokers that were very good mortgage brokers, but they aren't very good mortgage bankers. What happens is a small issuer can get an approval from Ginnie Mae and from FHA to issue securities. They may only do $50 or $75 million a month in mortgage origination business. They can take 1, 2, or 3 loans at a time now. They don't have to wait till the end of the month. They can do 1, 2, or 3 loans, put them into a pool, get them all certified by Bank of New York, who is the agent for Ginnie Mae, and Ginnie Mae will then sell them through their conduit to investors. So the small issuer in a small town anywhere in this country now has access to international monetary markets through the Ginnie Mae conduit. The problem is when these loans stop performing and go into non-performing status, they didn't figure out that they're on the hook for the payments of principal and interest to those mortgage pools. It is served to put a lot of small mortgage bankers out of business. It's further consolidating the origination business into the big banks. And it makes existing Fannie, Freddie, and conventional underwriters much less interested in becoming a bank, an FHA originator. Offer underwater homeowners in default principal reductions. The idea of principal reductions is coming around full boat. I think that I'll make a prediction in the next 12 to 18 months that principal reduction percentages of modifications will increase, what'd you say, about 5% in the world right now? Could be as much as 30 or 40% in the next 18 months. It is a huge number. If they can figure out how to do it fairly without the large moral hazard issues, which we're making good progress on, it's going to be a much bigger part of what the government does. Find ways to minimize and address the moral hazard issues. Some of those ways we're discussing and they're talking about in the halls of Congress now. And I'd be real interested to hear some of the academicians' feedback on this. It's not allowing mortgages to be modified with large-scale principal reductions unless they're 12 months or more past due. So you really cut out a lot of the strategic defaulters by doing that. And you deal with the seriously delinquent borrowers. But I'd love to hear my panelists' ideas on that. Keep homeowners in their homes that can afford them. That means payment modification, and those homeowners that have jobs that even if the payment was $1, they couldn't make if they were unemployed. So if they're unemployed and can't, then you got to find ways to keep current homeowners, make it easier for them to get into homes they can afford, either as buyers, renters, or rent-to-own. Those are programs that definitely need to be expanded. FHA has already started expanding a rental pool idea to try to keep some of the supply off the market. It's definitely gaining traction in Washington. You've got to start reducing cost to the taxpayer. The reduction in deadweight costs and REO labeled discount. I think we talked on the phone a little bit that FHA short sales or REOs draw much lower resale prices in the market just because of the stigma. You got to kill that. It's a huge part of deadweight costs. The deadweight costs also, with regard to agencies, the GSEs, the asset management, and the upkeep of the properties. We've had one estimate that deterioration numbers drop 7% a year, so just out of straight property deterioration. So adding private capital to the mix can help the right and the left get much more of what they want. When you sell REO properties and NPLs in default to qualified private investors, you get the non-performing mortgages off bank and government balance sheets in scale, and that's important, in scale. And you can include social engineering in terms of sale to the mortgages in default. FHA has a program right now called the 601 program, where they actually sell non-performing loans in an auction format. It's a pilot program, very small. They do it quarterly. But one of their requirements is that the buyer of the loans cannot initiate or continue foreclosure for 6 months after they buy the loan. So you can continue a short-term mortgage moratorium on the loans that you sell. You can require principal reduction. You can require forgiveness of arrearages. You can require reduced monthly payments as part of the terms of the sale. I can tell you right now, all four of those are being heavily considered by the agencies right now for the bulk sales. And you can do that in REO homes as well, but it's a lot easier to incorporate the social engineering into the bulk sale of the mortgages, like the rent-to-own plans. The problem here, and the big stumbling block in Washington is pricing these mortgages. I think Austin alluded to it in his presentation. You've got to find a way for the taxpayer and the investor to come up with the pricing for these NPLs. Auctions are not a great way to do it. We found out in the early 90s on the RTC auctions that that was not an efficient way to sell property. A couple of the reasons: valuing mortgages in default is expensive. Every homeowner and location is different. The product is not alike. Foreclosure laws differ state to state, as we're hearing now, is that's becoming a huge driver. You got to build your own model if you're an investor. You got to figure out what you're going to bid on this on a large scale loan, and that's costly and time consuming. Even if you work with the academic community in developing models, it's still very expensive. You got to buy data. I mean, when you're doing these large scale programs, Herb alluded to it a little bit, but some of the programs being discussed in Washington are 30 to 40,000 loans at a time. You start buying data for that many loans, it gets very expensive, and what happens is bidding on auction starts to get risky. Risky for who? First of all, much of the necessary data is confidential. You can't pull credit reports and things like that, and you don't know current incomes when you're bidding the portfolio. Redefaults are much harder to predict, especially in the FHA product, because they really haven't done a lot of modifications. There's no history on it. The biggest issue right now that we're running into in Washington is career risk. And this is where politics comes in, and personal futures versus the government and taxpayer. Career risk for government officials and for private portfolio managers. Well, let's talk a little bit about that. Besides the cost of valuations, bidders seek to minimize probability weighted returns on capital. So they're going to bring in their dry hole costs in the bidding, and that's going to reduce the bids across the board. Additionally, Wall Street has a habit of gaming the system, as everybody's seen. So auctions can be gamed. They can collude. They can form bidding groups. It's tough in an auction. The proposal that I'm putting forward this morning and is getting good traction in Washington is joint development between private capital and the government of a valuation model. So one of the gauntlets I'm going to throw out to this group this week is to think about how a valuation model might work in concert with private capital. Mortgages could be priced off a valuation of a fully transparent model, very much like the NPV model you developed at HAMP. If this is developed in concert with the government agencies, a cross-agency cooperation in concert with private capital, everybody would know how the model works. You take a lot of the risk out of the bidding. You get technical working groups of government modelers and private capital modelers. Private capital presumably would either be getting it off out of their own staffs on Wall Street, or they'd be going to the academic community to help develop a proprietary or to have input into a national model. Open source development, again, transparency. Test data on representative sample provided by the government. So you have an equalizer. Everybody can test their own model, can test the model that's being developed by the government and take a lot of the risk out of it. Even if you have the model, what you have to navigate through Washington, what you have to understand, and what I've been spending a lot of time on now, is navigating the aversion to career risk. Okay? Biggest problem in Washington right now, and you can talk about this in mortgages, you can talk about it in defense, you can talk about it in budget. As you start to look at government, saying no to new ideas is far safer for career staff. It really is just far safer. You don't get fired for saying no. Resource constraints cause poor performance and career danger. One of the biggest stumbling blocks is the agents say we don't have the resources to do it, and if we say go ahead and do it and it performs poorly because of poor resources, we can it's a career damager for us. Headline risk. Government really worries about private capital in this day and age. They look at Wall Street as some of the guys that caused the problem. So bringing private capital in there and having a headline in the Washington Post that Wall Street sharks eat HUD for lunch is a real problem. And then in a world and environment in Washington of shrinking and reduced budgets and resources, career staff, outside the political and appointees, the career staff look at this as one more rock in their backpack. I mean, it's a lot. They're getting thrown a lot to do with not a lot of resources. On the private side, dry hole costs. For large capital partners, that's a huge risk and embarrassment to their partners, to their investors. You drill too many dry holes, they pull the capital out and move it to a different manager. Bad investment returns. In this day and age, especially in the hedge fund world, this quarter's been pretty brutal. Another bad investment into the mortgage market right now could be a career ender for some of these portfolio managers. They have headline risk as well. They worry about getting stuck by the government. So once you overcome the career risk, and we're getting there in Washington, and there's several groups and advocacies who are, Here's when you know you've got the problem solved. In Congress, when you got a majority from the right and a majority from the left support a particular approach or program. It's getting there. It's tough in a presidential election year, but it truly is getting there. I've spent enough time with elected officials to hear that. Number two, you'll know when the administration starts seeing some headlines that a program is working. This White House and administration won't come out in front on anything on this particular issue. Housing is not as big a priority as jobs. I think they're focusing on jobs. I think all of us in the room know that housing is related to jobs, but the Congress and the agencies are taking a little bit more lead in this than the administration. Also, you'll know when American people say things aren't great, but they feel like the worst is behind us. And I think that's where you see that we're getting the problem solved politically. I can't say that the environment in Washington is particularly good, because it's extremely partisan and extremely segregated. But in housing, there's a universal belief that you got to find a political answer that includes private capital. It's coming around to the point now where bulk sales seems to be getting a lot of traction, because the problem has to be solved sooner rather than later. And if there can be proper controls, incentives, and safeties put on bulk sales and private capital, the left is becoming more trusting of that approach. So given the budget deficit, the budget and the deficit, that's what has to be done. So I think now we're going to, that's all I have. We're able to open it up to questions.
Let's give these guys a little hand. I really think we've had a panel here which has been unbelievable in gathering together some information, insight, and wisdom. And it's been really amazing. And thank Steve Patrick for getting these folks together. And I'd like to suggest that maybe in the Q&A we could just start with the panelists who may have some comments on the other panelists. And start there, and then if there are no questions from the audience, I'm not sure, I'm not shy. I have a few here to kind of get everyone warmed up. But let's just start with someone who's got some comments.
I'll start with two comments for Ron. At the end, as you were discussing career risk and how to make things move forward and whatnot, let me give you a little hopefully helpful perspective from the other side. We're talking about, hundreds of billions of dollars of taxpayer money, and we are audited and investigated and overseen like you wouldn't believe for that. Now, when I get the email from the IG or SIGTARP saying we'd like to meet with you next week, what time is good, I will not tell you that I'm overjoyed to get that email. But as a taxpayer, I will tell you that I think it's absolutely appropriate that we get that kind of oversight. And so I, grit my teeth and I have the meeting and we walk through things. When we get proposals from the private sector that say, let's do this bulk purchase deal, let's do this evaluation, I have this program. One of the things we have to think of, and it's not just careerism, it's, legitimate concern for taxpayers, is what are the auditors going to say? What do we need to have backup for when the auditors and the investigators come in? I would say the more proposals are laid out to be really clear, this is why the taxpayer benefits from this, and here's why it isn't smoke and mirrors, and here's what the fundamental gain is, and here's how somebody who comes in and oversees this program can say, they were right, this was a worthwhile gamble. And the more transparent you are about the uncertainties. I mean, if I take a risk on a program and it fails, I will get beat up. But if I have documentation that says we knew this was a risk, we tried to mitigate it, it failed anyway, I will get beat up less than if somebody says, you didn't know about that? So, the more these things are done with an eye towards the kind of oversight that we have to go through, the more likely they are to clear the hurdles. And the other thing is, having gone through this experience, I'm really interested in your proposal for getting together and jointly building models to do this. We should maybe get together and talk about that some more.
I agree. I think it'd be great to help put that together. I didn't mean to minimize the taxpayer issues on this, but I think that you do see a lot of proposals that I've seen come across my desk where it is smoke and mirrors. But that's why I think the joint proposal of a model to work with, where it's transparent and open source, will give both sides the most efficient pricing and not take advantage of the taxpayers, but also will give the private sector enough return to attract the capital.
I'll just make one, I'm not a poor model builder on my own right, but I do think it's really important to have the competition from multiple models with full transparency.
Good point.
As we discovered with